Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Caocao Inc. annual report. Caocao Inc. offers various businesses and services to cater to the growing demand for mobility solutions in China. At its core, the company operates as a ride-hailing platform, providing users with convenient transportation options. In addition to this primary service, Caocao also engages in vehicle leasing, allowing individuals or companies to rent vehicles for a specific period. Furthermore, the company has expanded its services to include vehicle sales, enabling customers to purchase purpose-built vehicles designed specifically for mobility operations. This diversification of services not only enhances customer convenience, but also provides an additional revenue stream for Caocao Inc. By offering a range of mobility-related services, the company is well-positioned to meet the evolving needs of its users and stay competitive in the market. Caocao Inc. maintains a market capitalization of $16 billion, broadly in line with the industry peer group. Caocao Inc. trades at a lower price-to-book ratio of -3.41 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 277% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Revenue growth drivers. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, an increase in gross transaction value, GTV, by 38.2% has significantly contributed to the growth. This is complemented by a rise in average monthly active users by 43.9%, indicating a strong user base and engagement. The expansion into new cities, with a total of 59 new additions, has also played a crucial role in driving revenue growth. Furthermore, enhanced market share through refined operations and standardized services has enabled the company to tap into new opportunities. A strong reputation and brand effect have also contributed to the growth, as customers continue to choose the company due to its reliability and quality. Additionally, the mobility services segment has seen a 36.8% growth, driven by geographic expansion, user traffic from aggregation platforms, and enhanced user satisfaction and loyalty. The vehicle sales segment has also experienced significant growth of 63.6%, primarily due to improved sales system efficiency and strategic expansion into new cities. These factors have collectively contributed to the company's revenue growth. Revenue decline drivers, on the other hand, the primary drivers of revenue decline are relatively limited in number. The others category has seen a 7.4% decline, primarily due to a reduction in vehicle leasing scale as older models were replaced. This decline is isolated and does not seem to be driven by any systemic issues or market trends. Overall, the company's revenue growth far outweighs its decline, indicating a strong and stable financial performance. The net income of the company experienced a significant decline, decreasing by 50.8% from RMB 1,246.4 million in 2024 to RMB 613.6 million in 2025. This represents a substantial loss for the year, with the company reporting a net loss of 613,635 in 2025 compared to 1,246,389 in 2024. On the other hand, the profit margins showed an improvement. The gross profit margin increased by 1.3 percentage points from 8.1% in 2024 to 9.4% in 2025. This indicates that despite the decline in net income, the company was able to maintain a higher level of profitability through its cost management and pricing strategies. The improvement in gross profit margins suggests that the company's efforts to optimize costs and improve efficiency had a positive impact on its bottom line. However, the significant decline in net income highlights the challenges faced by the company in 2025, which may be attributed to various factors such as market conditions, competition, or operational issues. The company is indeed generating positive operating cash flow. This can be seen in the net cash generated from operating activities, which shows a consistent increase over the years. On page 1 of the financial report, the company's net cash generated from operating activities was RMB 378,254. This figure remains steady on pages 16 and 24, indicating that the company has maintained its positive operating cash flow. Looking ahead to future projections, the numbers are even more promising. On page 31, the company is expected to generate a significant amount of net cash from operating activities in both 2024 and 2025, with RMB 716,748 and RMB 834,331 respectively. This upward trend suggests that the company's positive operating cash flow will continue to grow in the coming years. Overall, these figures demonstrate that the company is successfully generating positive operating cash flow, which is a key indicator of its financial health and stability. The company's debt level has undergone significant fluctuations over the past year. Initially, there was a notable decrease of 21% in total indebtedness from RMB 9,319,209 to RMB 7,322,569. However, this trend was short-lived as the debt level remained relatively stable at RMB 7,206,875 and RMB 7,218,287 on subsequent pages. In contrast, a substantial increase of approximately RMB 162,692,000 in debt level from RMB 403,257,000 in 2024 to RMB 7,300,000 in 2025 was observed. Furthermore, the total debt is expected to reach RMB 12.846 billion in 2025, indicating a significant rise. Additionally, there was an increase of 12.4% in total debt level from RMB 3,243,227 to RMB 3,646,815. In terms of interest expenses, there has been a notable decrease. Interest expenses decreased, contributing to the decrease in finance costs on page 10. A more specific example of this trend is seen on page 29, where total interest expenses decreased by 15% from RMB 327,967 to RMB 277,519. Furthermore, interest paid for borrowings decreased by RMB 50,506 from RMB 322,396 in 2024 to RMB 271,890 in 2025. These decreases suggest that the company has made efforts to reduce its financial costs and expenses. The company's recent performance has shown a mixed bag of results across various regions and segments. On the positive side, the domestic market and Geely Group partnership have been standout performers, contributing significantly to the company's growth. Additionally, international markets, lower-tier cities, enterprise services segment, and newly entered cities have also seen impressive growth. However, there are some areas that require improvement. Overseas markets, although not specified with exact performance metrics, seem to be struggling. This is a concern for the company as it looks to expand its global presence. Overall, while there are pockets of excellence, the company must address the underperforming segments to achieve sustained growth and success. And management is optimistic about the company's future, aiming for a balance between rapid growth and profitability. To achieve this goal, they plan to leverage their competitive strengths, geographical expansion successes, and momentum in robotaxi development. The company has set ambitious targets for its robotaxi business, including deploying second-generation vehicles globally by 2026, debuting third-generation L4 vehicles the same year, and commencing mass production in 2027. By 2030, they aim to develop an integrated air-ground service capability covering major cities nationwide. In addition to expanding its domestic market, management plans to internationalize the company's robotaxi business by leveraging Geely Group's global network. This will enable them to replicate their successful vehicles plus intelligent driving plus operations model in international markets, positioning the company for future opportunities in global commercialization. To support long-term revenue growth and market share gains, continued investments in user acquisition and market expansion are planned. Overall, management is confident that these strategies will drive the company's growth and success in the years to come. There is currently no cause for concern regarding inventory buildup or supply chain disruptions. The current state of affairs suggests that the flow of goods and materials is proceeding smoothly, without any significant issues arising from excess stockpiling or logistical bottlenecks. This stability in the supply chain is a positive development, allowing businesses to operate efficiently and meet customer demands without interruption. That concludes the financial summary for Caocao Inc. Feel free to comment below, and I will be happy to answer them when possible.